If debit and credit confuse you, this video will make journal entries permanently clear in the next few minutes. What is a journal entry? A journal entry is the first formal record of a financial transaction in accounting. Assets equals liabilities plus equity. Increase assets, the equation expands equally. Every journal entry keeps this equation balanced. Assets are resources owned by a business that provide future benefit. Examples include cash, bank, furniture, and accounts receivable. Liabilities are obligations the business owes to others. Examples include loans, accounts payable, and sales tax payable.
Equity represents the owner's claim in the business. Equity increases on the credit side. Revenue is income earned from business operations. Expenses are costs incurred to run the business.
Journal is where we record. Ledger is where we classify. Trial balance is where we summarize all transactions. If trial balance balances, it means total debit equal total credit, but it does not guarantee no mistakes. Purchased equipment for $50,000 cash. Step 2, create the journal entry and update the T accounts. Example 2, owner investment, cash debit. The owner's investment of cash increases the company's assets and equity. Accounts receivable debit, sales credit, revenue increases equity indirectly. Example 4, Haka sale of $100,000 plus 18% GST. Sales tax payable is a liability. Debit does not mean increase always. Credit does not mean decrease always.
Clarify properly.
Paid salary $30,000 cash. Salary expense cash credit.